Ed Pinto, so the American Enterprise Institute has a new product, the Wealth Builder Loan. What is that all about?
The Wealth Builder Home Loan is a 15-year loan that we've refashioned. It's a fully amortizing 15-year loan that we've refashioned so that it has the buying power that's very close to what a traditional 30-year FHA loan has. But it builds wealth very quickly because of that 15-year amortization. The problem with the 30-year loan is twofold. One, it's a very slowly amortizing loan, and two, it's combined with very high leverage, both debt-to-income high leverage and low down payment. And all of that together leads to a lot of risk, and it's used to buy a very volatile asset, namely a home. Homes are very volatile. Chip Case of the Case-Shiller Index just last, I guess it was in July, was quoted as saying, buying a house is a crapshoot. And because you're only buying one asset, a single address, it's not diversified, and it's incredibly volatile.
So where can people get this new loan?
Well, we're arranging for pilots, and the first pilot is with a low-income housing program that the Neighborhood Assistance Corporation of America, which has offices around the country, 37 offices around the country. They're slowly rolling it out starting in September, and we expect it over the next months following the rollout to be available in their offices. And then we're talking to other lenders about doing both additional low-income programs using the wealth building home loan and what we call a middle income or a no income associated program that anyone would be able to utilize. And we are talking to lenders about doing pilots there.
This might be unfair to a lot of mortgage bankers, but how is it that you came up with this concept as opposed to the mortgage banking industry itself?
Well, I've been in the mortgage banking industry since 1974, so it's 40 years. And I've been in credit, I've been in the lending side, I've been in the product development side, in and out for all of that period in various roles. I was Chief Credit Officer at Fannie Mae in the late 80s. I was Head of Marketing and Product Management at Fannie Mae earlier in the 80s. And so I've got a lot of experience in this area. And the policy that we've had for the last 50 years is a very strange one for housing. We've basically said we want to drive up the home ownership rate. And the way we're going to do it is we're going to put low-income people into highly leveraged loans. Low-income people that have volatile incomes, putting them in highly leveraged loans, 30-year fixed rate, low down payment, high debt ratios, traditional FHA type lending. And we're going to ask them to buy a house, a single asset, a home that is volatile to begin with, but low-income homes are even more volatile. We've looked at Zillow, and in every city that we checked, and we looked at, I think it was 28 cities, every single one, the low-income price range was much more volatile and had bigger declines than the high-income homes in the same city. And so that's a crazy policy, and it hasn't worked. When we look back, our home ownership rate grew from about 44% in 1940 to 62% in 1960. And that was a period when we had very conservative, rational underwriting standards, not a lot of leverage. FHA and the private sector both had conservative underwriting standards, and the homeownership rate soared. Starting in the 1960s, we have been practicing this curious policy of adding more and more leverage. And as house prices go up, we're kind of chasing our tail. We then say, well, we need to add more leverage. And we've been doing that, and we did that. FHA's been doing it for 50 years. And then Fannie and Freddie, at the behest of Congress, got into it in the early 90s. And they increased their leverage tremendously. And the result everybody's familiar with. We had a huge boom. House prices became unaffordable. And we had a huge crash, and we're still recovering from this huge crash. And so Einstein said, when you look at a problem and what caused the problem, the chances are very high that you can't solve the problem with more of the same. Well, what are we trying to do today? We're trying to solve a problem that we created with too much leverage with what? More leverage. So you hear the FHA commissioner, Carol Galante, and you hear the director of FHFA, Mel Watt, both saying very recently to the mortgage industry, you need to remove these credit overlays. Fannie Mae, Freddie Mac, and FHA are willing to do riskier loans than you're willing to do. Shame on you for having these credit overlays. When the lenders are saying, well, wait a minute, we're trying to be responsible citizens here. We don't want to put our borrowers into bad loans, and now you're telling us we should. Well, again, that's just more of the same crazy policy that we've had for 50 years. Another great quote of Einstein is, what's the definition of insanity? If you do the same thing over and over again and expect a different result, you're insane. Well, that's our housing policy.
Mortgage bankers seem to have a lose-lose situation because you have these agencies saying you need to do riskier loans, but you also have the CFPB saying, don't you even think of doing risky loans?
Well, it's worse than that. There was a great article in the Wall Street Journal 2 weeks ago that said, and if you have two standards, you do low-risk loans for your portfolio because you own them, and you do higher-risk loans for FHA or for Fannie Mae or Freddie Mac because you're selling them to them, even though they're asking for those riskier loans. That can be used as evidence that you were doing something wrong. Well, that's just setting lenders up for failure. But even more importantly than that, the whole basis of any market is risk-taking and pricing things properly. And here we have the government saying, we want you to put your capital at risk, but we don't want you to use judgment in risk-taking. Well, that is not a market. That's a government-mandated system. And that's what we have in housing in the United States. And so the Wealth Building Home Loan basically says, let's go to reverse engineer what we've been doing wrong for the last 50 years and actually say, no, what we really need is a shorter term amortization, and let's make that work. And I'll come back to that in a moment, but that's what FHA and the private sector did coming out of the 1927 housing crash. And so by 1934, 1935, FHA and the private sector were making much more sound loans. In fact, Congress in the 1934 Housing Act had a provision. It's going to sound very strange. The provision said that the FHA administrator, as the commissioner was called back then, the FHA administrator shall determine with respect to each borrower that the borrower has a reasonable ability to repay. That's in the 1934 Housing Act. Now, FHA immediately implemented that when they came out with their underwriting guidelines two ways. They set debt-to-income ratios, actually housing debt-to-income ratios, and they set a budget review, what's now known as residual income, which the VA still does. FHA abandoned that, I can't figure out when, but it was decades and decades ago. It was a mistake. And the VA has kept with it, and it's really helped the VA tremendously. The FHA abandoned many other sound principles that they had developed in the 30s, 40s, and 50s, and then they abandoned them. And so what we've done is go back to some of these principles, and we've taken what I call some tools out of the mortgage toolkit. So what have we done? We've said, okay, well, a 15-year loan, by its nature, has a lower interest rate. Interestingly, that difference between a 15 and a 30 is larger today than it was 5 years ago. It's widened. The market is now recognizing, because Fannie and Freddie have less mispricing going on, and FHA has less mispricing going on, they're recognizing that there's a real difference between a 15 and a 30 from an interest rate risk perspective. From a credit enhancement perspective, the market hasn't been as fast to recognize that. It's well known that 15-year loans, all other things being equal, have half the credit risk or half the default rate of a 30-year loan, 50%. So you take the same FICO, the same debt ratios, same LTV, and you're at 50%. Well, that's a huge reduction right there. But if you then add some things like the VA does, residual income test, looking at the budget, more stringent appraisal standards to protect the home buyer, making sure there aren't defects and repairs that haven't been identified that could affect the borrower's ability to pay during the first few years. If you look at those things, you can, in our views, decrease the default risk by 70%. Well, that's a huge reduction in credit enhancement costs. Thirdly, when you do a 15-year loan the way we're suggesting doing it, 77% of the principal and interest in the first 3 years goes to principal. That's over 75% of the principal and interest payment every month. So if you're paying $1,000 in principal and interest, $770 is going to principal repayment. On the 30-year loan, 67% is going to pay interest. $670 of a $1,000 payment is going to pay interest. Well, that has two impacts. Impact number one is, if you think about the principal repayment, you're really moving money from your left pocket to your right pocket. One of the beauties of the 15-year loan is it straddles the income statement of an individual, their debt-to-income ratio. You have a certain amount of income and you have a certain amount of debt. That's your income statement relative to your liabilities. When you look at their asset balance sheet, that's how much equity do they have in the house. Well, the 15-year straddles both because of the short loan term and the fact that such a high percentage of the monthly payments going to principal repayment. So when you make that $770 payment towards principal in those first 3 years every month, what you're doing is you're moving it from your income pocket to your asset pocket. You just created equity of $770, all things being equal. When you pay the $670 interest payment on the 30-year loan, you're moving it from your income pocket to your outgo pocket. It's gone.
Yeah.
And so that's because of that high principal repayment, that's really forced savings. Because of that, we believe it's prudent to use a slightly higher debt-to-income ratio. Remember, what has been the policy for 50 years? The policy for 50 years is take the risky loan and then goose the underwriting standards. We're saying take the low-risk loan, and that should have the slightly higher standards, not the 30-year loan. And so if FHA's average housing debt ratio is 28%, we think for this, all the things being equal, 30% is reasonable. Now, it's not like that money is, flying out the window. It's literally, again, going from the left pocket, the income pocket, to the right pocket, the asset pocket. And so that's the third feature. And then the fourth feature is we take the down payment. Let's say the average down payment for FHA is close to 5%. If you were to take that down payment and do a buy down instead, permanent interest rate buy down, which is very cost effective on 15. It's not as cost effective on a 30, but it's very cost effective on a 15. You can lower the interest rate by about 1.25. And that helps build wealth a little faster also, because it increases that percentage that's going to principal even further, because the interest rate component is now smaller. And so you then have a higher LTV. You can have a zero down payment loan. But what's important to focus on, and listeners may be surprised that I would be suggesting this given the view I've taken on down payments in 30-year loans, but this is a 15-year loan. What I'm focusing on is earned equity. Earned equity is a combination of the equity that you put in as a down payment and the equity you pay every month through amortization. Well, in the first year of a 15-year wealth builder loan, on a $100,000 balance, you pay more than $6,000 in earned equity. So if you start out at a zero down payment, 100% LTV, you're at 94% at the end of less than a year, and you're at about 80% after 3 years. That's the important number to focus on. And so we've basically taken these tools that have been around, and we've taken, instead of saying we're going to make loans as risky as possible, our goal is to say let's start with an instrument that's very low risk, and let's tweak it so that we deal with the affordability issue in a rational, sustainable way.
Wow. Where could lenders find out more about the product?
Well, they can contact me at the American Enterprise Institute. My email address is edward.pinto@aei.org, edward.pinto@aei.org, and I respond to those requests as I get them.
Excellent. Edward Pinto, thank you so much for being on The Housing Show.
Okay, my pleasure. Thanks, Phil.
This is Phil Hall for The Housing Show. Peace out.
The Housing Show airs every Friday at 11 a.m. Eastern Time and can be viewed exclusively on MortgageNewsNetwork.com. Thanks for watching us here on Mortgage News Network. You could be part of the action here. If you have a product or service for mortgage professionals, you can be a sponsor and have your commercial here on Mortgage News Network. And if you don't have a commercial, that's okay. We have plenty of clever and creative folks behind the camera who can make a commercial for you. For more information, please send an email to info@mortgagenewsnetwork.com. Or for immediate info, please call Beverly Bolnick, our National Sales Manager, at 516-409-5555, extension 4. And she'll tell you how you can be part of the action.
This is Mortgage News Network.